Welcome back to the deep dive. And hey, before we get started today, just a quick note. We really do appreciate you sharing all the source material with us. Seriously, if you find these deep dives useful for, cutting through all the noise out there, engaging with video, liking, subscribing, commenting, it actually helps us a lot, helps the channel get seen, and lets us keep doing this kind of in-depth analysis. Okay, so today we are definitely strapping in. We're doing a thorough analysis of, well, the asset that really started it all, Bitcoin. We're kind of framing this one as the decentralized digital gold standard, an investigation, if you will.
Yeah, the mission today is to get past those crazy price headlines you always see. We want to understand the actual tech, the scarcity that really defines it, and maybe most importantly, its real-world impact. This is all based on the stuff you sent us. So the big question we need to tackle, I think, is this. Has Bitcoin really cemented itself as this untouchable digital gold? Or does its future kind of rely on it becoming more like functional digital cash? Okay, let's unpack this.
Right. So just to set the stage quickly, Bitcoin came onto the scene back in 2009, created by the still anonymous Satoshi Nakamoto. And the absolute core idea here, the thing that defines it, is its structure. It's a decentralized digital currency. It runs entirely on peer-to-peer systems, which means, crucially, no banks needed, no governments, no middleman involved in any transaction.
And that freedom, that structural difference, that's really the foundation, isn't it? But
Yeah.
I think for a lot of people, the complexity or maybe the confusion starts when we talk about how it stays secure without a bank or some central body guaranteeing it.
Exactly. And to really grasp the value proposition, you kind of have to understand the underlying code, the mechanics. So the core infrastructure is the blockchain. You've probably heard the term. Think of it as a public ledger, like a giant shared spreadsheet, but it's immutable. It cryptographically links every single transaction, recording everything permanently. That's what gives you the transparency and, well, the permanence. Nothing can be secretly changed. Now, how do transactions get verified and added to this chain? That's mining. Mining uses a process called proof of work, or POW, and the sources you provided really emphasize something important here. The huge amount of computing power needed for POW isn't just about making it fast, it's actually a strategic choice. The cost, the sheer expense of the energy and hardware required for POW makes attacking the network like trying to cheat and spend the same coins twice just prohibitively expensive. So the security is, in a way, baked in through economics. It's just too costly to cheat the system.
Okay, that makes sense. But the main argument, the one that gets repeated constantly, Bitcoin is digital gold that rests mostly on supply, right, on the scarcity aspect. What makes it so fundamentally different from, say, the US dollar or the euro?
That's the absolute key difference. The hard cap, there will only ever be 21 million Bitcoin. Full stop. It's literally written into the software protocol. It guarantees a fixed, predictable supply schedule. And maybe even more importantly, this scarcity is enforced by something called the halving.
Ah, yes, the halving. This is where it gets really, really interesting, I think. For anyone not familiar, maybe explain that briefly. The halving mechanism is what controls how quickly new Bitcoins are created.
Exactly. Roughly every 4 years, the reward that miners get for validating transactions, which is paid in new Bitcoin, gets cut exactly in half. So each halving creates these predictable moments, these supply shocks, that systematically reduce the rate at which new Bitcoins enter circulation. It continues halving until eventually no new coins are issued at all. And this mechanical guarantee against inflation, against just printing more money whenever, is the single biggest reason it gets treated like a potential hedge asset. It's mathematically protected from the kind of monetary policy decisions that constantly affect traditional fiat currencies.
Right. We connect that scarcity, that programmed limit, to the wider world. Well, that's where we start seeing why Bitcoin matters beyond just trading charts and investment portfolios. It immediately speaks to its potential role as a hedge against instability, doesn't it?
Precisely. Because it's borderless, because it doesn't rely on any single country or bank, it can become a kind of safe haven. I mean, we've seen this play out. The sources mentioned places like Zimbabwe, Venezuela, countries where the local fiat currency basically collapsed. Citizens there turned to Bitcoin, not as a speculation, but as a vital tool, really, just to try and preserve their savings, what little they had left. It takes geography and, crucially, trust in local politicians or banks completely out of the equation.
Yeah, it really forces you to think, doesn't it? If your country was facing, say, 100% inflation, would you trust the code, this decentralized system, more than your own government's economic policy? And for millions of people around the world, the answer has apparently been yes. Okay, but let's pivot back to that digital gold idea. If it wants that title, we have to address how the traditional financial world sees it. Yes, it's been, like, the best performing asset over the last decade, historically speaking, but it's also famous for being incredibly volatile. How do the sources square that digital gold stability promise with these massive price drops? I mean, gold doesn't typically lose 70% of its value in a year.
That's a really important point, and it raises questions about its maturity as an asset class. Look, the volatility is definitely a risk factor, no question. But what the sources also show is a clear long-term trend, increasing institutional acceptance. And that is starting to bring perhaps a bit more stability or at least perceived legitimacy to the whole ecosystem. This acceptance signals that major players are starting to recognize its potential, maybe not just for quick trades, but as a serious long-term treasury asset. Take MicroStrategy, for instance. Michael Saylor basically transformed that company into, well, almost a Bitcoin holding company. They've accumulated over 200,000 BTC now. And that's not just a punt. He explicitly frames it as a corporate treasury strategy, arguing Bitcoin is fundamentally a better place to store value long-term than holding cash, especially with inflation concerns.
But the really big moment, the turning point for mainstream legitimacy, probably wasn't a single company, was it? It was when traditional finance itself stepped in. You absolutely cannot overstate the significance of the BlackRock ETF approval back in 2024. That was huge. Essentially built a formal, regulated bridge. Suddenly, trillions of dollars in institutional capital could access Bitcoin easily through familiar channels like buying a stock.
Right. It marked the moment Wall Street effectively stopped dismissing it as fringe tech and really started integrating it into their systems and offerings.
And this institutional embrace, it kind of connects logically to governments starting to take it seriously too, right?
It does. The sources highlighted El Salvador making Bitcoin actual legal tender in 2021. That was just monumental. I mean, think about it. A sovereign nation saying, yes, this digital currency is official money here. It cemented its potential function not just as something you invest in, but something you can actually use for transactions within a national economy.
Which brings us right into the heart of this deep dive, really, that central tension. Is Bitcoin fundamentally a store of value, like digital gold? Or is it meant to be a medium of exchange, like digital cash?
Well, the original design, the foundational layer secured by that energy-intensive proof of work, it's inherently slow. The main Bitcoin network can only handle, maybe 5 to 7 transactions per second globally.
Which is terrible if you want to buy coffee.
Exactly. It's just not practical for everyday small payments. Now, some argue, the Bitcoin maximalists, they'd say this slowness, this robustness, it's a feature, not a bug. It prioritizes security and decentralization, the gold properties, above everything else.
But others see that as a major limitation.
They do. And the sources certainly acknowledge the need for scaling if it's ever going to be widely used for payments. That's where solutions like the Lightning Network enter the picture. Lightning is what's called a Layer 2 solution. It's designed specifically to tackle that speed and cost problem. It basically allows transactions to happen off the main blockchain. This enables really high-speed, very low-cost micropayments. It's the tech that could potentially make using Bitcoin for everyday things actually feasible.
The challenge, though, is that Bitcoin isn't developing in a vacuum, is it? It's got serious competition now. You've got these other networks like Ethereum or Solana. They were built from the ground up with much faster transaction speeds, plus things like smart contracts, which Bitcoin wasn't originally designed for.
Absolutely. And they're aggressively positioning themselves as the real utility platforms for Web3, for decentralized applications, for DeFi. So the debate gets pretty fierce.
Is Bitcoin the foundational, secure value layer, the digital gold underpinning everything? Or will these faster, more flexible networks eventually steal the show because they can do more?
It's a fundamental question about the future structure of the whole crypto space.
What I find fascinating, though, based on the sources, is the sheer amount of data we have now to analyze what's actually happening. It goes way beyond just looking at the daily price chart.
Oh, definitely. You can, of course, compare its long-term price performance, say, over 10 years against traditional benchmarks like the S&P 500 or gold. And historically, Bitcoin has dominated those comparisons despite the volatility. But the really insightful stuff often comes from the technical on-chain metrics. They tell you about the health of the network itself.
Like the hash rate trend, for example.
Exactly. Think of the hash rate as like the network's total security budget. It measures the combined computing power that all the miners worldwide are dedicating to verifying transactions and securing the blockchain. So if you see the hash rate consistently trending upwards, even when the price is down, that's a powerful signal. It means more and more resources are being invested in the network's long-term security and robustness. It suggests strong underlying conviction.
And then you have metrics that track what actual holders are doing, right? Things like HODL waves and whale accumulation.
Yeah, let's quickly define those because they're quite interesting. HODL waves, HODL being the crypto slang for holding long-term.
Hold on for dear life.
Right. HODL waves basically show you how long coins have been sitting dormant in wallets. Have they moved recently, or have they been held for 1 year, 3 years, 5 years plus? This gives you a really crucial insight into the conviction of long-term believers versus short-term traders. If you see the waves for older coins growing, it supports that digital gold, store of value narrative. People are holding, not selling.
And whale accumulation. That sounds dramatic.
It just refers to tracking the activity of very large wallets, the whales. These are often institutions or very wealthy individuals, so these indicators basically show you, is the smart money, the entities with really deep pockets, actively buying up Bitcoin, or are they distributing it? It gives you a powerful lens on institutional sentiment that you often don't see just by looking at the price.
Very cool. And one last comparison point the sources mentioned was looking at the BTC adoption curve versus the historical internet adoption curve.
Yeah, that's a popular one. The argument is that if you map Bitcoin adoption onto the S-curve pattern seen with previous transformative technologies like the internet, it suggests that despite its already large market cap, we might still be in the relatively early stages of global uptake. Which, if true, would imply there's still massive potential for future growth ahead. Of course, that's a model, an analogy, not a guarantee.
Okay, so let's try and pull this all together. Let's summarize what we've really deep dived into today based on these sources. Bitcoin's core identity comes from its programmed scarcity, enforced by that unique halving mechanism. That's non-negotiable.
Right, and its legitimacy is being increasingly validated by traditional finance, especially through instruments like the BlackRock ETFs, which opens the door for huge institutional flows.
And a key driver for its adoption, particularly outside the developed world, is often real-world fiat instability. It presents itself as a decentralized alternative when trust in traditional systems breaks down.
So the synthesis, I suppose, is that Bitcoin is currently juggling multiple roles, sometimes roles that seem almost in tension with each other. It acts as this potential ultimate hedge against global economic uncertainty. It enables borderless payments, especially with scaling solutions like Lightning, trying to solve the speed issue. And perhaps most critically, it functions as that secure, hard-cap foundational value layer, maybe the digital cornerstone, you could say, for this whole emerging Web3 ecosystem.
Which sets up our final provocative thought perfectly, something for you, the listener, to chew on. Given the rise of these super fast, highly functional networks like Ethereum and Solana, which are really built for utility and applications, and considering Bitcoin's ongoing identity struggle, is it gold or is it cash? Do you think Bitcoin will always remain the undisputed #1 crypto asset? Or could an altcoin, maybe one focused purely on utility or speed, eventually flip Bitcoin in terms of overall relevance and impact in the global financial system? Lots to think about there. Thank you again for sharing your sources and joining us for this deep dive. We'll catch you next time.